In our past episode, we discussed about going concern with commercial property as the context. Now we're going to talk about going concern with self-managed super fund as the context. This is something that I'm seeing quite a bit now in the industry, especially with self-managed super funds. It's understanding what this term means. And it means, in short, does the super fund meet or will it meet its obligations moving forward in the future? In this episode, we're going to talk about what that means, what you need to look for, so you don't get any queries from a self-managed super fund auditor questioning about the going concern of your self-managed super fund. Welcome to What School Should Have Taught You, a podcast where I share with you all the lessons you need to know about building true wealth. I'm Jeremy Iannuzzelli, and today we're going to talk about the going concern in relation to self-managed super funds.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Now, as an accountant for the last 17, 18 years almost, I've been doing lots of self-managed super funds with my clients, assisting them through all the red tape and the bureaucracy involved about financial accounts and tax returns. I've dealt with many auditors in my lifetime and in my career as an accountant. So understanding what the auditor wants to see is important, and educating your client of what needs to happen is also just as important. So I spend a lot of time every year with my clients educating them about all the conditions, all the red tape and the bureaucracy involved about making sure that their self-managed super fund is compliant in relation to the SIS Act. What's the SIS Act? It's a very special act that makes sure that all super funds are doing the right thing, or members of the trustee or trustees of the super fund are also doing the right thing. And what those things are: not taking money out of your super fund when you shouldn't be. Obviously, that's for the time when you're at retirement. Making sure you're not misappropriating the funds and doing everything for the benefit of the members. But more recently, in light of the current economy that we have and in light of the current interest rate environment that we're in, I'm starting to get questioned from the auditor about the going concern of the self-managed super fund. I'm going to give you a really good example of what that is. I'll give you an example regarding a couple of clients of mine. They're elderly clients in their very late 50s. They've just decided that they want to look at slowing down work-wise. They want to reduce the amount of hours that they work. Now, as we know, when we reduce the amount of hours in most circumstances, we also reduce the amount of pay that comes into our bank accounts. As a result of reducing the amount of pay, our superannuation contributions start to reduce as well. Because generally speaking, and at present, superannuation contributions are at 11.5%, heading up to that new threshold of 12% very soon. So these clients are starting to reduce the amount of superannuation concessional contributions that are going into the fund. They do have a property in the fund. And as we all know, interest rates have substantially increased over the last 24 and 30 months. That means that interest rates are starting to really bite into the amount of income that's coming into the fund. And that income is coming into the fund through two sources: the rental income that the property is providing, and also the concessional contributions that the members are making. The auditor has a look at this fund every year and makes sure and audits the compliance around the super fund, ensuring that all expenses are being paid, the right expenses are being paid, the members have not done anything silly. Now, the question that the auditor is starting to ask is, do I believe as an auditor that this fund has enough money to continue on, i.e. raising the going concern statement? Now, I need to explain to the auditor and also explain to the individual what that actually means and how the members of the super fund are going to address this issue. And it could be through additional contributions they can make, either as concessional or non-concessional. But in light of this, we need to advise the auditor what we're going to do. So again, just reiterating what I'm saying, we've got a property in the fund, high interest rates are starting to really chomp into the rental income. We're now very negatively geared in the fund. Our superannuation contributions have started to reduce, and they're reducing because our two members of the fund have started to pull back in terms of the work. And now the superannuation contributions going in are not really meeting the obligations of holding that property long term. The auditor has addressed this and said that I, as the accountant, along with the members of the super fund and the directors of the trustee, which is a company in this particular case, we need to address how we're going to make sure that this super fund has longevity continue. it meets the going concern. So it's very important, if you're going into a self-managed super fund, you need to make sure that you're looking at all aspects of the fund, not just the initial aspect of buying the particular property, but understanding the costs involved. Higher interest rates are generally charged in super. You've got compliance costs from an accountant, from an auditor. You've got supervisory levy fees. You've got insurance costs that you need to meet. So a fair chunk potentially of the contributions that you make go towards servicing the property and the assets of the fund. If the contributions that are going into the fund are starting to really diminish and get eaten up by the fund's investments, then you need to address the going concern issue. And the auditor needs to be, beyond reasonable doubt, understanding that this issue's been met. And if it's not, potentially they could contravene the fund, which means that you need to come up with an idea of how to fix it. And if that contravention is not being rectified, potentially the ATO can get very involved in your fund and make you work out a way of what you're going to be doing to move forward to get the fund in a compliant status. So very important when you're understanding the going concern issue in super, it's more so, is there a longevity of this super fund to continue? And what contingencies have you got in place to ensure that this super fund has longevity for your retirement and making sure that you've got a substantial amount of wealth come retirement age? I'm Jeremy Iannuzzelli. This is what schools should have taught you. Don't forget to hit that like and follow button on our YouTube channel. And if you're listening on iTunes and Spotify, don't forget to hit follow. Looking forward to seeing you next episode.